So let's start off with the, I think the yield curve might be an interesting place to start off. 21 basis points separates the 2-year note from the 10-year note. It's not very much. What signal does that send to you about the economy and about your outlook for where rates ought to go?
Yeah, I started talking about this last December, and there has been a good debate on Wall Street and within the Fed about what to do. A lot of people have said maybe we shouldn't knowingly invert the yield curve. I agree with that. I don't think there's any reason to take on the yield curve, take on the possible recession risk that you'd be inviting, and so I think we should be very careful.
Is this the market saying no more? That you're here, you're where you want to be, you're at neutral already when you get to a flat yield curve?
The market is not seeing that much growth out in the future. They're not seeing that much inflation pressure, or maybe very little inflation pressure out there in the future. And that's why the 10-year hasn't been able to meaningfully break through 3% and stay above. I think you can still cling to the hope as we continue to raise rates that the long end will go up, but it's not looking like it just sitting here today.
We just had a very strong quarter, 4.1%. Our CNBC rapid update tracking other tracking forecasts is at 3.2 this morning. Another strong quarter after that. Have you changed your growth outlook for 2018, and do you think it continues?
Well, I think it's going to be a good year, and part of that is fiscal stimulus and other factors that have come into this year. But the point is, it's going to slow in 2019 and 2020. That's the standard forecast that's out there. So this is, as a baseline, I think that's what you should have in mind.
The administration has a point of view on this, which seems to be different from what I'm hearing from a lot from the Federal Reserve. Administration thinks it can sort of change the DNA of the economy, so to speak, in that it can raise potential growth by cutting taxes on corporations, increasing capital investment, increasing productivity, and ultimately this leads to real wage gains. Do you not buy into that scenario?
No, those are beautiful things and laudable goals, and the deregulation agenda is pushing in that direction. The corporate tax cuts are pushing in that direction. But from a policymaker perspective, for monetary policy, that should not be our baseline case. Our baseline case should be probably the growth that we're seeing now, taper off, and we'll go back to potential, which is pretty low.
No change of potential.
So, potential could come up to 2%, or, a lot of people in the Fed have it at 1.75, maybe 2%, maybe a little over 2%, but not 3 or 4%. But if it does happen, take that on board. We can make policy if that does happen. That'd be something
you don't have to be
preemptive about that.